The stock market returns about 10% per year on average, but the average investor will only get about half that. Here's why. Now, you may or may not remember that the stock market kind of tanked last year, and in 2023, we've already had to deal with a looming debt crisis, record high unaffordability of everything from houses to blueberries, and rising interest rates. So it would stand to reason that as the economy gets worse and worse and worse, stocks would too, right? Wrong. It's hard to believe, but as of the time of this recording, we're recording on June 21st, the S&P 500 is up 14.47% year to date. Wait, what? Despite what we had all assumed, given everything going on right now, the stock market is thriving, and there were plenty of investors in 2022 that pulled out. But now, if they're trying to buy back in, they're doing so at an extreme premium, instead of experiencing the rally and reaping the rewards of those gains. If you sold shares for $5,000 at the end of 2022, it's now going to cost you $5,725 to buy back those same shares, assuming we're talking S&P 500. And that's the lesson here. When you ignore the advice to buy and hold, you are doing so at your own peril. And before you say, but Katie, isn't it different this time? Not really. Probably not. Because, okay, do you remember the stat that I just told you about how the average investor is only going to get roughly half of what the S&P 500 is going to average over the long term? In a Dalbar study, the 30-year return of the S&P 500 was 9.96%, while the average investor only got 5.04%, which is a big yikes. And if you want an even bigger yikes, a graph from JP Morgan Asset Management Analysis shows that between the years of 2003 and 2022, 7 of the 10 best days for your investments occurred within just 2 weeks of the 10 worst days. AKA, had you just held on, waited through the worst days, you would have gotten to experience the best days within 14 days of the worst ones. And here's the thing. In 2022, when my brokerage account turned into an incinerator and every dollar I was throwing in was immediately taking a haircut, I felt the fear. I was scared. I wanted to taper back. But I had also already been consistently investing for about 4 years at that point and hearing over and over and over again, hey, you're gonna hear when things are hitting the fan. This time it's different. It never is. Just hold on. So I was kind of able to rationalize my fear and stick to the plan. Because stock market volatility is a little bit like turbulence on an airplane. Even if your rational mind is like, hey, it's okay, nothing bad is going to happen, realistically, the chances of something going catastrophically wrong, slim to none. It doesn't really matter. When you are getting tossed around like a crumb in a Pringles can at 30,000 feet above the earth, it is not your rational mind that is in the driver's seat. It is your fight or flight response from your amygdala. So instead of making that investing mistake, there were a few tips and tricks that I picked up during that time that I want to share. This way, we're not going to lose our mind or our money for the next inevitable downturn, though fingers crossed. Here's the most important thing. Buy and hold is a long-term strategy. So the best thing you can do is nothing. And if the data from 2003 to 2022 didn't persuade you, a time period that included not one, but 2 of the worst economic downturns in history, maybe what's happening right now all around us in 2023 will. If you're an investor like me in your 20s or 30s, keep in mind you are playing a long game, and embracing that boredom and inaction is key. Secondly, and we've talked a lot about this on this channel and on the Money with Katie show, but building your portfolio the right way in the first place is crucial. Intentional diversification proactively is key. That way, when things start going awry, you're just kind of bracing for a dent instead of total impact. We will link the episode or the video that we've done on constructing a diversified portfolio in the description of this video, but including things like small cap funds, international funds, bond ETFs, emerging markets, it can all go a long way. Finally, remember that yes, downturns in your portfolio can be very unsettling. You may feel this really strong instinct to stop the bleeding, to do something to make it stop, to stop putting in more, to pull out what you already have. But it's important to remember that you still own the same number of shares. And it's only a loss if you sell. Otherwise, the number of shares that you own are the same. And that's ultimately the only thing that you can control. And bonus, you can buy even more at an even lower cost. The truth about the stock market is that it can stay irrational far longer than we can stay solvent. But over time, all of those turbulent moments will smooth out and the plane will land safely, but only if we stay calm. Because remember, in this analogy, you are the pilot. And things are going to be okay as long as you don't panic. That's all for this week over here on YouTube, but if you want to hear the full deep dive, click the link in the description of this video. And before we go, comment below what you thought the most interesting part of this conversation was, and please like and subscribe to our channel if you like these videos. And I'll see you next week, same time, same place on The Money with Katie Show.